All right, thank you very much for joining us on this not-for-profit revenue recognition and lease webinar for nonprofits. We're going to be focusing on the new accounting standards affecting nonprofits. And lucky nonprofits, there are not one, but two revenue recognition standards that you have to be dealing with. So we'll talk about both of those and then discuss the lease standard as well a little bit before wrapping up. Once again, thank you very much for joining us. My name is Adam Kellerhals. I am a Senior Manager with Smith Schaefer out of the Minneapolis office. I've been with Smith Schaefer for about 10 years on the audit side. I work with audits, reviews, anything financial statements, and besides working on nonprofits, also work on for-profit entities as well. We have 3 offices across the state: Minneapolis, Rochester, and Red Wing. We have a couple exciting things we like to share as we go through. First off, Smith Schaefer was recognized as a top workplace in Minnesota in 2019 for the 4th year in a row. This is something we're very proud of and something we've worked for. Also, Smith Schaefer is one of just 30 firms across the country recognized as a clear-rated 2019 Best of Accounting Award winner. This is based on client surveys, and we received a 9.4 out of 10 satisfaction rating from our clients. Obviously, being a client-oriented firm, that is something that's very important to us, and we are proud to have received that award. So today's agenda. As I mentioned, there are 2 revenue recognition standards that we'll be discussing. First, the general one, and then one specific to contributions. We'll talk about leases, take on some questions, and then wrap it up. So as we work through this presentation, I have a tendency to use some acronyms. I am a CPA, as all CPAs do. We love our acronyms. And so this slide is just to give you some information on what acronyms I'll be using and referring to throughout this presentation. So what are we talking about today? Today we're talking about Accounting Standard Updates, ASUs. ASUs are issued by the Financial Accounting Standards Board, or FASB. And what they do is revise the accounting standard codification, which is basically your GAAP, or your generally accepted accounting principles. With that, we will move right into ASU 2014-09, revenue recognition. Now, this standard is not specific to nonprofits. This standard is basically the revenue recognition for all industries, for-profit, nonprofit, everything in between. And what it did is remove virtually all current GAAP related to revenue recognition. It introduced a 5-step approach in recognizing revenue, created some new terminology that we'll be using on our statements, and it is effective for years beginning after December 15th, 2018. So basically your 12/31/19 year ends and thereafter. So what type of accounts or activity might you see that cause you to have a revenue recognition problem? Well, if you have certain accounts on your statement of financial position, you might have a revenue recognition problem. And that might include deferred revenue, prepaid membership, customer deposits, or maybe you should have some of these or similar accounts on your statement of financial position. But also you could be offering certain services to your members, your donors, your grantors, and that includes discounting on programming, or maybe you're offering multiple services or goods throughout a single sales transaction. So a lot of this may not appear to be relevant to 501c3s, but any 501c6 that has membership or sponsorship, or even the C3s that have donor contributions, and you maybe give something away if you receive a donor or a donation. Perhaps if you don't donate at the $500 level, you get a free ticket to the annual gala. Well, that transaction is now slightly different than it would have been recorded in the past. And now you're all of a sudden dealing with this ASU where you wouldn't have had to deal with revenue recognition in the past. So let's talk about the 5-step approach. 5 steps Step one is to identify the contract with the customer. We're going to talk about the definition of a contract in a little bit, but right now I just want to make sure people don't lose interest because of the word customer. You can replace customer with member, donor, grantor, or really any description that you would like. It can be any of those people. It does not have to be what we would consider a customer in the general term. Step two, we identify the performance obligations. Performance obligation is a new terminology, and we'll discuss that. Step three, we then have to determine the transaction price. Step four, we allocate that transaction price to the performance obligations in step two, to the contract that's in step one, and then finally in step five, we get to recognize some revenue, we have to make some journal entries, we actually get to do some accounting. So we're going to walk through this five-step process. We're going to use an example of a trade association, or what probably would be a 501c6. But again, you don't have to be a C6 for this to be applicable to you. This standard is very principle-based, meaning any type of sales transaction that falls into the realm of a sales or an exchange transaction needs to follow this five-step process. So we're going to use the following example as we go through these five steps. So trade association charges $1,000 for an annual membership. Members' dues renew on their anniversary date, so their original date of joining the association. Membership includes a quarterly publication, monthly emails related to the industry, access to exclusive content on the website, and a 10% discount to the annual conference. The association's quarterly publication discusses and highlights research issues and trends of interest to the members and others in the industry. The association also sells these quarterly publications to non-members for $150 per issue. The standard cost of the conference is $250, and based on historical trends, the association expects 40% of its members to take advantage of that 10% discount at a type of conference. The conference is in October every year, and a new member has joined the association and paid their $1,000 in dues on June 1st, 2019. So step one, we identify the contract with the customer. Well, again, we've already talked about customer is not really a customer. It can be a donor, a grantor, or a member. But contract is also not a contract in the sense of something you may have read about in a business law class or something you might take someone to court over. This contract is the definition of, or FASB's definition of a contract. So it is different than any other definition you've ever heard for a contract. There's technically 5 criteria that we're not really going to go into, but what we really need to know about step one and the definition of a contract is it's a very low threshold. For the most part, if you're receiving money from somebody, chances are that's going to justify a contract. And so the reason it's such a low threshold is because FASB wants you to achieve step one. If you can't achieve step one and have a contract, you can never get to steps 2 through 5. So again, that threshold is very low. So in this case, the trade association is providing members with membership benefits. That is our contract that we'll be considering as we go through the rest of the steps. So step 2 talks about identifying performance obligations in the contract. So performance obligation is new terminology, but we don't want to overthink it. A performance obligation is basically what we have promised in the contract to give to the customer, the member, the donor. And it's the real key here is to have distinct performance obligations. To have a distinct performance obligation, the person receiving the item has to be able to benefit from the item received independent of any of the other performance obligations. So in our scenario, the customer, because the association sells the quarterly publications, that means you can benefit from the quarterly publications by themselves. So that introduces additional performance obligations. So in this case, the number of performance obligations we have there on the screen is 6. And what that is the quarterly publications, so that's technically 4 of the 6. You then have the general member benefits that the association does not charge non-members for, does not make available to non-members. And then you also have the discount to the conference. So that discount has created a performance obligation. So again, we have a total of 6 performance obligations that we have to consider as we continue moving through these 5 steps. Step 3 is to determine the transaction price. In this case, our scenario is pretty simple. We only gave one price, and that's the $1,000. In reality, most organizations or most associations are going to have a lot of different price points, and all that's going to affect how you calculate and how you allocate the transaction price. So having discounts on memberships, having early bird discounts for registration, different membership levels, all those things that can affect the transaction price may make it more difficult to allocate and complete steps 4 and 5. So that's just something to keep in mind as you go through this process. Do you have multiple transaction prices, and how are the multiple transaction prices going to affect how you allocate in steps 4 and 5? So step 4 is the allocation. Step 4 talks about, it requires you to look at the standalone selling price of your independent performance obligations. So as we discussed, we have the 4 quarterly publications. Well, we know those standalone selling prices. We actively sell those. So that's $150 each. So we know the standalone selling price. But then we get into the membership benefits, and that has the asterisk next to that, and that is defined below, and that's saying that since we don't sell this membership benefits or memberships without the quarterly publication, it's hard for us to really know what the standalone selling price is. So we basically have to estimate. If we offered some sort of membership level, let's say for $800, that didn't include the quarterly publication, then we know exactly what that number should be. But since we do not, we have to come up with a price. And that could get kind of complicated if you don't have anything to base it off of. You really have to look at all the membership benefits you are providing to members, or what you're providing to donors in the transaction. So in this case, we allocated $500. We looked at everything we provided and determined the price was $500. But then we have the discount to the conference, and we allocated that to $10. So how do we get to $10 on that? Well, that we have to look at our calculation. So we said that conference registration was $250. We have a discount of 10%. So everyone's discount is $25. The problem is we only expect 40% of members to actually exercise this option and attend our conference. So that reduces our anticipated discount from $25 down to $10. And that's how we get that $10. We're basically saying on average, all members can save $10. So back to the allocation, at this point it's basic math. Now that we've come up with standalone prices, we have to do basically a ratio of the $150 over the $1,110 and multiply that ratio by 1,000. And that's how we get to the 135s for the quarterly publications, the $450 for the membership benefits, and then the $10 still for the discount. The $10 just due to rounding did not change. So now that we've allocated everything, we have to actually make some entries. So we have a series of entries here. First off, a new member joins. Well, we get the $1,000 in cash. We don't actually have any revenue. All that $1,000 goes to a contract liability. That's the new terminology. Contract liability would replace something like deferred revenue that you might currently have on your statement of financial position. And then we talk about the quarterly publication. So at the end of June, we issue the quarterly publication. Well, now we know, based on step 4, that we get to allocate $135 of the membership dues to the quarterly publication. So now we reduce our contract liability by $135 and get to finally record some revenue. In this case, I'm calling it membership revenue for $135. That's the entry we would make every quarter. But then we have the monthly membership benefit. The monthly membership benefit is looking at that $450 that we allocated. We're saying that the members simultaneously receive and consume benefits from those membership benefits equally throughout the year. And therefore, we're able to take the $450, divide it by 12 months, and we'll pick up $37.50 each month. That works really well for this scenario. The problem is maybe you have quarterly events or you have semi-annual events. Your structure might change, in which case you'd really have to look at, is 1/12 accurate for each year, or excuse me, for each month, or do we have to change that a little bit so that we're picking up more revenue at the end of a quarter or after a certain event? In this case, it works to do 1/12. So again, we would, in theory, make that entry 12 times. But then we also have the conference registration. The conference registration would be, someone would give us cash for $225. Remember, that's the $250 registration fee less the 10% discount. So now we get $225 in cash. We've allocated $10 to the contract liability that's still sitting on the statement of financial position. We get to recognize that finally into membership revenue, and then we have the $225 into conference revenue. The most important part of all of this, all these 5 steps, is probably the first sentence below the entry. All of this calculating and all of these additional journal entries can go away if your membership year is the same as your fiscal year. Because at that point, that contract liability will have been fully utilized at the end of the member year. So my member year is 12/31. I would have made my 12 monthly entries. I would have made my conference entry. I would have made my 4 quarterly publication entries. All that would have been made in the same year. There's no accounting or 990 requirement or audit requirement in the middle of anyone's membership year, and therefore I can kind of disregard a lot of this and just pick up that $1,000 as revenue at the front of the transaction. And again, 501c3s, this may apply to you. What a 501c3 has to deal with is maybe they have some sort of dues, quote unquote, dues revenue. Again, maybe you say, join at the $500 level, you'll get these type of benefits. Well, the standard says you have to bifurcate. That's definitely a standard word. That's not something I use in my regular vocabulary. You have to bifurcate how much of that is a contribution and how much of that is some sort of benefit to the member, some sort of tangible benefit. So again, these 5 steps are not just for for-profits, not just for 501c6s. Anyone might fall into this standard and might get caught based on their transactions. So other things to consider if you do fall into this standard, we have some presentation concerns. First off, like I mentioned, you have new terminology. The new terminology, contract asset or contract liability, both of those replace a lot of those the deferred revenue and those items I listed on an earlier slide that indicated that you could have a revenue recognition problem. On the transition side, it gets a little interesting. For our for-profit entities, we suggest doing single-year presentation if you have to change your accounting math. If you're going to have to recalculate your contract liability or contract asset, recalculate that deferred revenue, we suggest only doing single-year presentation because you have to go back to the earliest period presented and restate your deferred revenue. And so obviously there's a lot more time, a lot more cost associated with that. So if you can only do single year, it's just going to save you some time and money. It's a little bit harder to do single year presentations for a nonprofit based on your users. Some of your users might want to see that comparative information, but it's definitely something you'll want to consider. From the disclosure standpoint, there's going to be more disclosure related to revenue recognition. It's basically going to walk through those 5 steps and identify any estimates or any assumptions you made throughout that process. So future steps related to this standard, you're going to want to identify basically any transactions you have that fall into this standard, identify your multiple performance obligations, identify your distinct goods and services, and start documenting your 5 steps. Start documenting what you think your accounting is going to look like under this new scenario. So that's a real quick summation of what our first revenue recognition standard is addressing. And again, it is the wide standard. It's for for-profit entities, and it also covers nonprofits in their specific transactions. So we're going to move forward to part 2 of revenue recognition, and we'll move forward to ASU 2018-08. As you may guess, this standard was issued by FASB in 2018. And the standard was released basically because ever since revenue recognition came out, the original standard, nonprofits kept asking the question, does this actually apply to us? How do we have to record revenue? So, surely enough, 4 years later, FASB finally came through for you and issued their own standard on contributions. And what this standard does is assist in evaluating transactions and determine if they fall into a contribution bucket or an exchange transaction bucket. It determined and kind of reintroduced a concept of a conditional contribution. Ultimately, FASB believes this will affect the timing of when revenue will be recognized. FASB believes this standard will cause more contracts to be considered contributions and more contributions to be considered conditional. So it is going to affect the timing. So although this standard came 4 years after the original standard, it did not change the effective date. So the effective date coincides with the rest of the revenue recognition standard, and it is effective for years beginning after 12/15/2018, or the first ones will be 12/31/2019 year ends. So this standard is really focusing on, it's 3 parts that it focuses on. And the first question it asks is your transaction a reciprocal transaction, meaning an exchange transaction, or a non-reciprocal? So a reciprocal would be just like the example we just went through. I'm going to give you $1,000, you're going to give me membership benefits. As it says there, it then falls under ASU 2014-09, and it's considered a sales transaction. Non-reciprocal transactions would be, I'm going to give you $10,000 to help feed the homeless in Minneapolis. Well, I'm not receiving a direct benefit from that. I have nothing in exchange, so then that transaction is a non-exchange, non-reciprocal, and is thus a contribution transaction, and is accounted for under the non-profit standards and codification. So if you have any contracts with government agencies, this is the big thing that they're trying to focus on and fix. Having a contract with a government agency, maybe you have a contract with the city of Minneapolis, for example, and in the past you might have said, well, the city of Minneapolis is giving me this money, and I'm not necessarily benefiting. The city of Minneapolis isn't benefiting from my use of the money, but the general public at large is benefiting. If they gave me $100,000 to help feed and shelter the homeless population, well, the general public is benefiting from that as well. Well, this standard took that option off the table. It said the public cannot be the benefactor to qualify as an exchange transaction. So they're going to say that that $100,000 that I'm receiving from the city of Minneapolis, for example, is in fact a contribution from the city of Minneapolis. That's slightly different than if the state or some sort of government agency is providing a service specifically for identified people. Think more of Medicaid, where they're paying on a specific person's behalf. That would still be a reciprocal and exchange transaction. But for the most part, you really are going to have to look at your contracts and make sure you can identify who is benefiting. And you can no longer say that the public at large is the benefactor. So now we've went through the first step, and we've determined that if our transaction is reciprocal or non-reciprocal. We're going to stay in that non-reciprocal bucket because that's what falls under the standard. So then step two is if it is conditional or unconditional. And we'll just go over that definition in a little bit, but the important thing to note is that a condition is different than whether it's with or without a donor restriction. You can have a condition in your grant, but have it not be with donor restriction. Those words seem very similar, the concepts seem very similar, but they are in fact two different tests and two different things you have to consider. So let's talk about a condition. For a condition to exist, two things have to be present. First, there has to be a right of return of funds or a release of future payments of those funds. The grant, the contribution, has to say something to the extent that if you don't fulfill this grant, we want our money back. Okay, so that has to be present. It doesn't have to say that explicitly, but it has to be in there in some way that the funds are due back to the donor. Secondly, a barrier must be included in the grant or the contribution. We'll talk a little bit more about what a barrier means, but the important thing to note that's off to the side of your slide there is if a gift is deemed conditional, it is no longer revenue until that condition is met. It will stay as a liability on your statement of financial position. That's kind of a significant change, and you have to be careful for these conditions because it could affect how you're recording revenue and the timing of that revenue. So let's talk about barriers a little bit. There are two main types of barriers. The first would be a measurable performance. A measurable performance might be that I will give you $10,000 and you must provide 1,000 meals to elderly seniors, for example. Well, in the past, let's say you received this contribution on December 31st. So on the last day of your fiscal year, you got this $10,000 contribution. And it said you need to provide 1,000 meals in order to keep these funds. Well, in a whole year, you're going to have 10,000 meals given away. So this 1,000 meals is not hard. It's very obtainable. You know you're going to obtain it. In the past, you may have recognized that revenue on December 31st. Well, now you cannot recognize that revenue until you have actually provided the 1,000 meals. So on December 31st, instead of recording a nice deposit and revenue, you're going to be recording a deposit and a liability. The same goes for a matching contribution concept. If someone says, here's $1,000, you get to keep the money as long as you raise another $1,000 to match. Again, in the past, since that threshold is pretty low, we would have recorded that in revenue. But now we have to say, you have to go out and raise that $1,000 before you get to recognize the initial seed money, that initial $1,000 gift. Again, we're going to increase liabilities and reduce revenue recognition on the front end. Ultimately, you'll still record this as revenue once you achieve those conditions, but it is going to delay when you get to recognize the revenue. The second type of barrier, and this one's a little more complicated to fully differentiate between a condition and a restriction, is limiting the discretion by the recipient. So this would be guidelines about qualifying expenses, or maybe you have to use a very specific workforce. So if I requested a grant, let's say I need a grant to build a building. So I asked for $100,000 to help me build a new building. And I got a grant back. And the grant says, all right, here's your $100,000. It is in support of the grant that you submitted. It is to help you build your building. All right, that would be a restriction because we asked for money to build a building. You gave us money to build a building. But if that grant came back and said this money is to be used to build your building, and your building must meet these qualifications, it must be LEED certified, or it has to have solar panels, or it has to be any sort of restriction on how it has to be built, that extra restriction is now requiring you to have some sort of qualifying expense. And now all of a sudden that gift or that grant is not restricted, it has a condition on it, and you have to meet the condition first before you ever have to worry about whether you meet the restriction. So again, limiting your use of how you can use the funds is now a condition. Might also be a specified workforce. Maybe you have to hire a new person, and the new person has to have certain qualifications, be from or have certain abilities, and until you actually hire that person and have payroll for that person, you will not have the qualifying expense and will not be able to recognize revenue related to that grant until you have incurred those expenses. Again, limited discretion by the recipient is going to be very complicated to make sure you understand whether it's a condition or whether it's just a restriction. For the most part, I would say a safe bet is if you have additional restrictions. It's not a general restriction of what you ask for. It's that very specific, but it's something you'll want to look at on a grant-by-grant basis. A barrier, and this is very important to note, administrative tasks or trivial tasks are not considered barriers. Most grants, even to get the second year of funding, require you to fill out some sort of report on how you spent the first year of money. Well, that's just an administrative task. That's just a report. That's not a condition that's going to limit you from recording a 2-year grant receivable or grant or some sort of contribution. So this standard, from a presentation standpoint, it doesn't actually require any new disclosures, but that's a little deceiving because technically we've always had conditional gift required disclosures, and those required disclosures are amounts, purpose, and when you think the condition will be met. So that is still relevant and is still required. It just so happens now we expect there to be more conditional gifts. So you're still going to have a new disclosure. It's just technically not a new disclosure. On the transition side, they were much nicer to nonprofits. They basically say, look at the first day of your reporting period. So for example, if you're 12/31/18 year end, you'll look at 1/1/19 and say, okay, whatever revenue I recorded in the past is recorded in the past. I'm not going to restate. I don't have to consider what shouldn't have been recorded and what should be recorded. I just have to look at what's going on in the future. So that's a little bit nice from the transition side. You just have to look forward. Future steps related to this concept or this standard is really look at your contracts. If you have any contracts with mostly government agencies, but really anybody that you're recognizing revenue on, you'll want to look at those contracts and make sure you understand, is this reciprocal or a non-reciprocal transaction? And then you'll want to review your grants, your larger contributions, and make sure you have grant letters or some sort of contribution letter so you can identify those right of return barriers or any of those conditions. This is going to be a new focus or a renewed focus during any audits to make sure we fully understand the barriers or the right of return. So you want to make sure you have the information available to make sure that you're accounting for it correctly and that we can audit it at the end of the year. If there are any questions or concerns about what your grant is saying, if there is actually a right of return or if there is a condition, it's probably easier to get that information up front from your grantor rather than starting to spend the money and then be like, oh yeah, how exactly was I supposed to do this? Were there any restrictions on this? So something early on in the transaction is when you'll want to introduce those questions to your donors. All right, exciting news. If anyone's still awake, we have made it through revenue recognition. We're going to move on to leases. Again, leases are not nonprofit specific. This is a standard that is applicable to nonprofits, for-profits, but as a nonprofit, if you have long-term leases, this is going to probably change your financial statements in a way that you're not necessarily expecting or you haven't seen in the past. So what this standard does is it creates new presentation and disclosure requirements for all your leases. Lease expense or your rent expense is recognized in a very similar manner as today, so not a big change on the expense side. And this is effective for years beginning after December 15, 2019. Currently, there is a exposure draft out there in front of FASB that presumably will get approved in October here that will push out implementation of this for non-public entities, so privately held entities and nonprofits. They'll push it out a year, so you'll actually gain a year on this, and it will be effective for years beginning after December 15, 2020. So you're really talking about your 12/31/2021 year ends, which sounds so very, very far away, but it's still not that far away, and you'll want to be considering your leases now and not necessarily wait for that last minute if we do get that 1 year reprieve. So let's talk about our current lease types before we get into the lease types that are presented in this new standard. Currently, I'm going to say we have two types of leases. We have what's called a capital lease, and a capital lease would be a lease that is for probably equipment, and you're going to gain the right of ownership to that equipment at the end of the lease. So that's what we refer to as a capital lease. Currently, that capital lease has an asset recorded on the books and a liability recorded also on the statement of financial position. If it doesn't qualify for a capital lease, we have what is called an operating lease. And an operating lease is basically all your other leases, and currently that operating lease is just on the income statement as rent expense, and then there's a disclosure related to operating leases within your footnotes. Well, FASB redid it, and it introduced three types of leases. The first one is a finance lease. Well, a finance lease is just new terminology for a capital lease. If you don't have a capital lease now, you're not going to have a finance lease just because you went through implementation of this standard. You then also, they have a definition of a short-term lease, and a short-term lease is anything less than 12 months. If you don't fall into either of those two buckets, you then get an operating lease. So let's talk about how these types of leases are going to be presented on your statement of financial position. Finance lease, like I said, that's just a capital lease. So it currently has an asset and a liability. In the future, it's going to have an asset and liability. They just have different names. You have a right of use asset and now a lease liability. Overall, not a big change. The operating lease is where you will start to see your big change. Your operating lease will now be presented on your statement of financial position as, again, a right-of-use asset and a lease liability. So you're going to have new accounts, and you're going to have new debt. You're going to have debt for all these leases that you'll have to record. Short-term leases have a practical expedient, so you do not have to capitalize them if they're less than 12 months. Short-term leases, I have a little asterisk there right next to not applicable. Again, technically you have a practical expedient. You have to elect to not capitalize those. But the asterisk is really there to make sure that you don't try to cheat. Trying to get out of this standard by making all your leases short-term may not be the best option. You want to make sure you're still making the best business decision for your nonprofit when you're signing your lease agreements. A friendly landlord this year that's willing to give you a short-term lease so that you don't have to deal with this standard might not be so friendly next year. Might all of a sudden get an option to rent out your space to another entity who wants to sign a 10-year lease, and all of a sudden your short-term lease is a benefit to them, and you get kicked out of your space. You don't want to make business decisions based on these accounting standards. If we look at the statement of activities or the income statement, again, the finance lease isn't going to have a big change. You're going to have amortization expense and interest expense. The operating leases are still going to have your rent expense. It's going to be calculated slightly differently, but overall, you still have your rent expense. Short-term leases also just hit the statement of activities and are through rent expense. So those are the three types of leases that were identified very clearly in the lease standard. The lease standard, though, also introduced this concept of an embedded lease. And an embedded lease is a service contract that has an identified asset inside of it. It doesn't have to be a service contract, but a service contract is going to be your most likely scenario. So let's consider if you are, you're on the cloud, so you rent server space. So you rent server space from a provider, and if your contract talks about you're logging into this very specific server, serial number XYZ, and this is the one you log into, I am in charge of telling you when you have to replace that server, but you're in charge of making sure it's plugged in, making sure it works, making sure I can access it. Well, that is an embedded lease because I have an identified asset inside of it. Compared to if I have the same type of contract, but it basically just says I'm going to log into a server. It's going to be one of these 10 servers. I have no control over which one. I have no control of when you replace them. I just log into them every day. Well, that is a service contract that has no bearing on the lease standard. But as soon as you identify that asset and you have control over the asset, you have an embedded lease. And the problem with an embedded lease is you have to look at what type of payments you're paying for in that embedded lease. You have to break out your lease component, so what you're paying for that actual asset, and your service component. The service component would not need to be capitalized, would not have to be recognized as that right-of-use asset, but the server component or the asset component would need to be capitalized. So now you're breaking down and nitpicking your service contract. There is a practical expedient that you could say, I'm not going to break it down, I'm just going to capitalize my whole payment, but you need to be careful because that is going to gross up your right-of-use asset. So let's talk about the right-of-use asset and how that is calculated. The right-of-use asset concept is really just a time value of money concept. So you have 3 inputs, and that calculates your right-of-use asset for you. That first input is your lease term. So your lease term sounds pretty easy. I've signed a 5-year lease. My lease term is 5 years. Well, sure, that could be true. But what happens if your lease has some sort of extension opportunity in there. So I have a 5-year lease, but I can renew for 3 additional 5-year terms. Well, now you have to look at your terms, those additional terms, and determine if you are reasonably assured to execute that extension. If I'm reasonably assured that I know I'm not going to go anywhere for at least 10 years, I know I'm not. I'm going to definitely execute that first extension opportunity. Now all of a sudden, I have a lease commitment for 5 years, but I have a lease term for 10. And when I calculate this right of use asset, I have to use 10 years as my lease term. And then I have to look at my interest rate. Well, there's 3 options for interest rates. In a couple slides, you'll see your options for the interest rates. We're not going to spend any time on the interest rates because you're going to choose the easy answer. You're going to choose the risk-free rate that applies to your lease term. So in my case, I said I had a 10-year lease term after I consider my extension. So I would find the risk-free rate for 10 years, and that would be my interest rate in my calculation. And then I have to consider my payments. There's 3 types of payments I can consider. There's my fixed payments, so my fixed payments in my leases. I have variable payments, but to be variable and to be included, my variable payments must be based on some sort of rate or some sort of index. So maybe they increase 3% a year, or it increases by the consumer price index. It has to be based on some sort of rate or index to be included in this right of use asset. And then I also, if I'm entering a new lease and pay some sort of commission to a broker, that commission can also be put into this right of use asset. Items that are excluded, one I want to mention is any legal fees you incur in creating a new lease. Those are just period expenses and have to be expensed as incurred. Those cannot be capitalized. So we've talked about the 3 types of leases that the standard has created. Let's talk about the real world a little bit and the 2 types of leases the real world has and how they equate to your right of use asset. So in the real world, you're going to have a net lease or a gross lease. If you have a net lease, the term net is referring to your base rent is net, your common area maintenance charges, your insurance expenses, and the real estate taxes. So I'm going to use my base rent for my right of use asset. So that number is going to be significantly lower than my total payment. My total payment might be $10,000, but $6,000 of that payment might be covering my CAM, my real estate taxes, and all those types of charges. So I only have to consider my $4,000 because my CAM expenses are not a fixed payment, because there's usually some sort of reconciliation at the end of the year to reconcile actual CAM versus paid CAM, nor are they a variable payment based on a rate or an index. They don't fall under either of those categories, so I exclude them from my calculation in a net lease. On my gross lease, I might again say I have to pay $10,000 a month in rent, but it's not breaking down which portion of that is CAM and which portion of that is my base rent. It just says $10,000, it covers it all. Well, now all of a sudden my gross lease, that $10,000 payment includes CAM and thus services that I'm receiving. Services for clearing the parking lot of snow, cleaning the common areas. All those things are services. Well, we already talked about if we have a service within our lease, we might have an embedded lease. So now with our gross leases, we have to consider if we have an embedded lease and then break out the $10,000 monthly payment. Is that how much of that is for rent and how much of that is for my common area maintenance or my services? And that's only for the common area maintenance charges. you might be able to break out those common area maintenance charges because it's a service, but for your real estate taxes and your property insurance, those are going to stay in your payment. Bottom line, if none of that made sense, that's okay. Here's what you need to know. If you have a gross lease, your right of use asset is going to be higher compared to a comparable lease if it was a net lease. The payment terms are relatively the same, or payment amount is relatively the same. Your gross lease is going to lead to a much higher right of use asset, and that's a much higher lease liability, and you're going to have a larger lease liability on your financial statements. Again, interest rates, as I promised, there are your three options. Slide 35 has the risk-free rate. This is going to be the rate that you're going to use. It's going to be the easiest. It's not going to be worth calculating any of the options. Transition related to this lease standard. Again, you have to adjust the earliest period presented. So you're going to have to go back, if you have comparative financial statements, you're going to have to go back 2 years, recalculate everything, and represent basically your statement of financial position as of the earliest date. Again, a little more work, a little more cost involved. If you think you can get away with single-year presentation, it might be a good option based on your lease activity. Future steps for this standard: find your leases, find your service contracts, make sure they're readily available, start looking at them to make sure you understand them. Once you have accumulated all of them, you can consider a lease capitalization policy, which would be very similar to a kind of a fixed asset capitalization policy, and be applicable if you have a lot of copier contracts, a lot of postage machines. If you have some of those leases and you want to try to exclude them, you can possibly come up with a lease capitalization policy. But again, the first step is finding them so that we can do a calculation on those leases. So before I open it up for questions, I'm just going to run through and kind of wrap up the presentation. So I would invite you to join us on our Facebook event group page, Connect Us. This is our event focus page, and it gives information about future events, opportunity to network with other people that were included in our events, and early registration for future events. Speaking of future events, we do have a couple coming up both in the Metro and Rochester area. In a couple weeks, on October 17th, we have a tax and retirement planning tips session in Golden Valley at the Golden Valley Country Club. And then on December 3rd, we have a business tax seminar down in Rochester. For more information related to those, please visit our website. Also, to register, you can visit our website. Please also consider connecting with us on our many social media platforms. And if you do have any questions and you don't necessarily want to try to explain it in the question box on the GoToWebinar, or you think of it after you log off, feel free to reach out to anyone here at Smith Schaefer or myself. My contact information is up there on the screen. Reach out to us. We'd be happy to talk with you and make sure we get any questions answered. For the most part, these standards are going to be significant changes to for-profits, nonprofits, and you'll want to make sure you are considering how they will affect you specifically. So again, this has been recorded. You will get the recording, a copy of the PowerPoint, and in the handouts, there's also kind of that scenario we ran through on the first revenue recognition. All those things will be emailed to you today. Once we wrap up here this afternoon, you will get those in your email, so you have an opportunity to review the slides. Otherwise, we will take questions and answer them as they come in. If you don't have any questions, thank you very much for joining us today, and please contact us if anything comes up in the future.